Good evening, traders. My name is Matthew, and welcome to today's session. I will be speaking about fundamental analysis, and there are several items on fundamental analysis, but today we want to focus on inflation and interest rates. Welcome all, and if you have any questions, feel free to send it over on the chat and we will revisit it. So the objectives for today is to discuss a little bit about what interest rates are and what inflation is, and then how interest rates and inflation interact in an economy, and then look at how the changes in the two items, that is the inflation and interest rates, influence instruments, how the news reports items give inflation data on economic calendar, and then how traders interpret the inflation and interest rate data to make trading decisions. So interest rate is the charge that a country's central bank does for the use of its currency. It's the charge that enables the central bank to regulate the economy. So central banks will either raise rates to decrease supply of a currency in the economy, or reduce the rate to increase the supply of the money in an economy. So increasing the interest rate decreases the supply, and raising the value of a currency against others as a result. On the other side, if the rate is decreased, then it means that the amount of money available in an economy, or the supply, increases. That lowers the value of the currency against others. So just to explain a little bit, we're talking about the level of the cost of money in an economy. For example, if you borrow, how much are you going to charge to be charged for holding that currency? Okay, the interest rate that you pay. The central bank sets a benchmark rate that banks follow. So when the central banks raise the rates, then it means the other banks as well, the commercial banks, are going to set the rate higher. So if you wanted to get money from a bank, then it means you're going to pay a higher rate if the central bank has set the benchmark rate a little bit higher. So where you increase the costs, then it means it's expensive to get money from a bank. The amount of people who are going to get, or the number of people going to get that money from the bank, will decrease, because people usually do not want to pay a higher rate. People usually want to evade or avoid higher costs. In this case, the cost of money, which is interest rate, when it rises, it increases the cost, hence reducing the amount of money in an economy. So inflation is where we're talking about the level of prices of goods and services in an economy. Whatever you're paying now, if that price increases in the future, then you can say inflation is rising. So rising inflation actually decreases the value of a currency. So the rate of inflation is reflected in the currency value, and hence the purchasing power relative to other currencies. Purchasing power is the strength of that currency. So a country with high inflation has a weaker currency compared to the currency of a country with a low inflation rate. With high inflation, it means there's a lot of supply of that currency, hence the weakness of that currency, or the low value of that given currency. So if you expect a rise or fall in inflation, then the central bank is going to take an action, and this one can lead to an expectation of a fall or rise in the value of that currency. Remember, it's the mandate of the central bank to manage the inflation. This one happens across all countries globally. So how does interest rates and inflation interact in an economy? Usually when an economy is growing, the amount of money being created rises, and there's a tendency of the inflation increasing. Yeah, although there is a level that is considered normal. So over time, so long as there's growth in the economy, you cannot avoid a rising inflation, but it's considered 2% as a normal. If it's going beyond that level, or if it's accelerated over time, then it raises alarm, and central banks have to come in and try to regulate. So in the event where the inflation cannot be contained with the normal money supply, money demand, or the economic growth in an economy, then the central bank has to intervene. And the way they intervene is through the interest rates. And when you have high economic growth, increasing supply of money in the economy, then it means inflation is increasing. When there is high money supply in an economy, it means there's a large amount of money in the hands of people. Yeah. So that currency tends to lose value. And in that event, when you've got that high money supply, then the way of reducing that money supply or reducing that amount of money in the hands of people is through raising interest rates. That is how inflation brings up the aspect of interest rates either going high or lower. So the central bank banks a whole economy, and then the decisions of the central bank has to trickle down to the commercial banks. So the central bank has a mandate of controlling or regulating their interest rates and inflation in the economy, and they do that through the monetary policy. So when they decide they're going to increase the interest rates, then they want maybe to regulate the amount of money in an economy, and that means they're reducing the inflation. Central banks cut money supply, and that action is considered as quantitative tightening, trying to tighten the amount of liquidity in the economy by raising rates. And that is the event of high inflation. Central banks also raise money supply, which is considered as quantitative easing, or trying to loosen the lending a little bit. They lower the interest rates so that the central banks have got an incentive, or they have got an incentive to offer money with a lower cost. That is the event where there is low inflation and they're trying to excite the economy or try to improve the level of activity in an economy. So all this is tied to there's an aspect of economic growth, okay, and slow economic growth. So that's how interest rates and inflation interact. Maybe to give more insights into this is, for example, during the time of COVID, when the people had closed businesses and economic growth went really low, so the action that governments took was to try and increase the amount of supply, try and motivate people, try and encourage businesses to go back to increase production. And that is by giving them money, quantitative easing. That's what was happening, right? So in that case, they lowered the rates so that borrowing could have been a little bit lower. You remember, like the case in Kenya, where some charges were even reduced, even for some lenders, right, to allow people to have as much money as possible. Now, what happens later when the economy picks up and growth starts to kick in, then it becomes a challenge as well. And that's the situation we are in right now. So to try and cut that amount of money which is in the hands of people, then the banks again central bank again starts increasing the interest rates to discourage a lot of lending, right? Or try to cut the amount of money in the economy. So that's why we've been having a series of interest rate hikes. So how does the changes in the two items influence instruments? When I talk of instrument, it's the asset. So high interest rates reduce supply of money. Yeah, when they reduce the supply of money, then it makes that specific currency scarce. Let's say, for example, it is GBP, and the Bank of England announces or increases the rates. Then it reduces the supply of that GBP, makes the currency a little bit scarce. Its value rises. When its value rises, it strengthens as a result against other currencies. So any pair which is placed against GBP is likely to weaken against it because of that. When the rates are lowered, that's when increases the supply of that currency. It means it's available cheaply. So that makes the specific currency, for example, if it is euro, available, hence it falls in value or weakens as a result. Now let's look at how traders, before we look at that, let's consider the report items that give inflation on economic calendar, considering how the inflation and interest rates are connected. The CPI is a consumer price index. This one shows the level of prices in an economy, generally on goods and services. Then there's producer price index. So the consumer price index, that's on the level of consumers, what the consumers are taking, how much, or the level, the index of the prices of goods in an economy, how much people are paying for services. Has it gone up or lower? And it's compared with the previous months or previous year or previous period. Producer price index, this is the amount of money that the price that manufacturers or the producers mark their prices, or the prices that the producers mark for their goods that they produce. The price that the producers will mark their goods once they produce them. Remember, that one goes to the end consumer. So if the producer has been producing their goods at a higher cost, to cover that cost, then it means that they are going to raise that to mark their prices higher. The final consumer has to take up that. Still shows the level of prices rising in the economy. Personal consumption expenditure, this one is specifically for the US. This is the amount of money that the citizens or the people of that country are willing to allocate to expenditure from their earnings. So how much are you going to set aside to consume from what you're earning? Personal consumption expenditure. The wages or the labor costs. This also indicates inflation in the event where if the employers are paying a lot to the laborers or for the labor, then it means they're going to pass that costs on to the consumer because they have to cover their expenditure. They have to cover their cost of production, right? So if the cost of labor is higher, if a company is hiring their employees for a little bit higher salaries, whatever services they're producing, they have to mark up the price, which has to be taken by the consumer, so that at least they maintain their revenues and they're able to sustain in the business, sustain the business. So these are the various reports Remember, this inflation can as well be inferred from other economic reports, but these are the direct ones, very close, that you can use to get inflation. Now let's check on interests. Interest is reportedly, how do you get interests? Reports. This one is gotten directly on the calendar. Okay. So the chair of the central bank or the governor of the central bank, usually with the stakeholders, decide on the rates. In some cases, we have the member made up of committees that they vote and decide on the rate, like in the case of US and even on the UK. But for the interest rate, the traders usually, yes, they look at the rate which is given on the calendar, but most of the times they will try to speculate on what they are expecting the decision to be, or the decision they're expecting from the central bank stakeholders based on the inflation data. For example, if the inflation has been rising, then it's possible for investors and traders to start inferring that there's a likelihood of the central banks raising the rates now, or in the next meeting, or in the next month. Another way that interest rate decisions can be inferred or can be expected is from the sentiments of the stakeholders. For example, if the chair of the Federal Reserve is speaking and they speak in a certain way that they are hawkish. Hawkish means they're supporting higher interest rates. Yeah. Then it's going to lead to a reaction in the market or an expectation that they favor higher rates, maybe in the future dates. If the stakeholders speak in such a way that they are dovish means they're favoring lower rates, then the traders will expect that in the next date where they will be announcing the rate, they're going to lower it. So there's something called pricing in. Traders will start entering trades or taking positions that are in line with lower rates if it's dovish, but still the date is not yet for the announcement. That is pricing in. But usually the final announcement, when it is done, or when the actual date of the rate change arrives, then traders again start anticipating what will happen next. So the sentiment from the speeches of the stakeholders drives the price more in line with the interest rates, because it has already been priced in and such. So this is the direct interpretation of the inflation and interest rates data by traders. If a trader has been, if for example, you were expecting the previous rate was 4 and the expected is 5, so that expected rise makes the currency strong. If actually the interest rate rises by that number, then it confirms the strong currency, and then traders look for buying opportunities. If it is a fall in interest rate, for example, a lower number is expected, then it weakens the currency. If actually the lower rate is announced, then traders look for selling opportunities because that currency loses value or weakens. Note that for commodities like gold, gold is used as a hedge over inflation. This means that people buy gold when they want to protect themselves from inflation. They move from other instruments, they buy gold to protect themselves from inflation. There are other currencies like US dollar, which are used as a hedge over inflation because they're considered strong. and CHF as well, and even JPY sometimes. So when the inflation sets in, right, it makes interest rise. When the interest rise, then the instruments which are considered to be a hedge of inflation, with the rising interest rates, then those instruments can fall because of the high rates. And that is the discussion for today. But let me share our economic calendar so we look at how those events look like on the economic calendar and what you're going to look for. I'll use the most commonly known economic calendar. So here we have Forex Factory economic calendar. There are other economic calendars which you can use in the market. So you can go and search and you'll find them. For today's session, we'll just look at the Forex Factory to see how to look at the news. So when you search the calendar, for example, here on August 15th, you can see at 4:30 and 3:30 p.m. This is East African time, GMT3. AUD, we had wage price index. So the wage price index, if you want to learn more how to understand these events, click on that detail and you can understand a little bit why traders care, because it's a leading indicator of consumer inflation. When businesses pay more for labor, the higher costs are usually passed on to the consumer. So you can go check and see why the traders care and also look at the previous data. But most important is when the wage index goes lower, right, it's considered negative. Like you can check again and see how it's treated. So greater than forecast is good for the currency, but if it's lower, it's bad for the currency. But again, it means a reduction in the wages. So look at the CPI, Consumer Price Index. If it's a higher reading, it's directly interpreted as positive for that currency. But if you look at it in terms of the interest rates, then the traders will start to expect a further rise in rates to try and cap their inflation. So those two things, interest rates and inflation, they go opposite to each other. Even for the wage price index, now when the wages, when the index is lower, that it means lower or the inflation is reducing. So then that one decreases the likelihood or put the expectation of a lower expectation of rise in interest rates, right? For the GBP as well, the CPI year on year. So you can have year on year or month on month, okay? And if it's a good news, depending with the current situation, it might signal, it comes positive for the instrument, for the GBP, but again, the traders will try to speculate what step or what does it mean for the interest rates, or what step is the government likely to take. So if there has been a pressing inflation problem over time and it keeps on increasing, yes, here it comes as a good news for that instrument, but then that one means that the government, for example, the Bank of England, is likely to keep hiking rates, right? So that's the interpretation for this news. In the event where these high impact events, you see that the inflation events are usually high impact. If you can see here, they are rated high impact rated with high impact expectations. So it's advisable that traders, if you're using these events, you understand the risk which comes with it. But of course, there's a great opportunity. It's a chance for you as well to make as much money if you take time and analyze, get the right movement on the charts. And that is the presentation for today. So the advice is, before you start trading, go and check on the economic calendar and see, are you expecting any report coming up? And one of the reports we're going to look at is the CPI, PCE, or PPI for the instrument which you want to trade. If you're expecting that event and you expect it's going to be a high impact event, then it's advisable you stay out of the instrument for the time being before the news is released. Once it is released and you see the results and you analyze the results, you see it's a good news, so it's making that instrument strong, then you can enter. But before that, you cannot really know how it might move. And the moves take the moves are very explosive, right? Or they really drive the market to very big changes. I do not want to be caught up in a move I don't understand properly why it's happening. So that's the presentation for today on inflation and interest rates. I will take the next few minutes to answer your questions if there's any. I see Edwin is waving. Hey Edwin, hey Tony, hey Ruben. Welcome to the session. You have any questions for me? The next few minutes. All right, it doesn't seem like there's any question. With the news, it's just clear that the news that you check on the economic calendar, and what comes on the economic calendar will show up on the price action. Once it shows up on the chart, then it can shape your decision. So first, you can, if you don't know how to use the news, first you can understand when the news is coming, check on economic calendar, and avoid a little bit trading during that time to avoid the risk. That is when you don't know how to use the news. But if you know how to use the news, take the opportunity, set your trades, and get the maximum profit that you can get from the market. Yes, Tony, you have a question? Please type it up. Seems like we lost him again. So traders, thank you so much for your time. Let's keep learning and watch out for the events when are coming up, specifically CPI interest rate decisions. Thank you.